Hello, so this is for chapter 8, the results in capital gain and capital losses. So when we start talking about capital gain or capital loss, we wanted to know that how are you going to calculate that? So as you can see from the screen, to calculate capital gain or capital loss, you use a proceeds of disposition, the POD, less any adjusted cost base, ACB, and then deduct any costs of disposition. So any cost related to the disposition, you can deduct it. Then if you get a positive number, you get capital gain, and a negative number is capital loss. The proceeds of disposition may also include other costs in addition to the sales price of the property. So for example, the related proceeds from insurance policies on the damaged property that were sold would also include into the proceeds of disposition amount. The adjusted cost base include the original costs of the property, but also other amounts need to be included in the amount as well. So for example, if the taxpayers receives government grants or assistance towards acquisition of the property, those assistance or grant will be reduced the ACB of the property being sold. So it will be deducted from your adjusted cost base. If it's positive, we already talked about that is capital gain. There are only half of it, capital gain will be taxable. If it's negative, it will be capital loss. There are only one half amount of capital loss will be allowed to deduct a capital gain. So we have learned that already, right? So therefore, we call the capital gain is taxable capital gain, and we call the capital loss as allowable capital loss. There are also one exemptions. We mentioned about this in chapter 6, that a depreciable property and eligible capital property, there's no capital loss realized. Okay. Okay. So the next slide, we talk about superficial loss. The superficial loss is the taxpayer disposes of a particular capital property of loss within 30 days before or after the date of disposition. The taxpayer or affiliated person, like the taxpayer spouse, the common law partner, require the same or an identical property. So the definition we can see from that slide, taxpayer dispose of a particular capital property and a taxpayer affiliate person acquired the same or identical property within 30 days before or after the date of disposition. The consequences will be the loss on the disposition is called a superficial loss and cannot be deducted. However, the losses add to the ACB of the property that is required. So the loss is denied and add to the ACB of the property to the purchaser. We can show examples so you can get more understanding about this topic. Okay, example. Taxpayer purchases 100 shares on January 15th for $15 per share, and another 200 shares on March 12th for $20 per share. The ACB is, the ACB per share is $18.33 on December 20th, when she sells all 300 shares for $16 per share. She repurchased 300 shares on January the 5th for $15.5 per share. So she sold on December 20th and purchased another 300 shares on January the 5th. What is her ACB for the shares? What is adjusted cost base? So we just talk about the rules. Superficial loss, right? If you have a trade-in within 30 days before or after the date of disposition, then the superficial losses will not be deducted. Now we see the solution. Solution. Capital loss is denied on December 20th sale. So we calculate the capital loss. We use 300 times 16, deduct $18.33. So $300 is total shares shares she sell, and then the $16 is the sell price. $18.33 is the adjusted cost base per share. So there's a capital loss about $700. The adjusted cost base of the new share, because she acquired 300 shares on January the 5th for $15.05, right? So we use 300 times $15.05, and then you have to add that $700 capital loss. So the adjusted cost base for the new share will be $5,350. However, the taxpayer purchased the share after the 30 days of disposition. The capital loss is considered not after, within. So as we said, is considered as superficial losses. There's not an out, but we need to add back the superficial loss into the ACB of the new share, therefore increasing the adjusted cost base. So that is how this works for this example, right? You can see from the solution. The new ACB has been adjusted. And then after you finish this topic, you can refer to the textbook. You can do the exercise 8-2, and then you will have more feeling, or you're getting more sense about this topic, about superficial cost. Identical property. When we talk about identical property, so the cost determined using weighted average of all purchase to date of sale. So we know we have learned this weighted average method from the financial accounting, right? So, but we're gonna give example if you by any chance forgot how to do by using this method. So a taxpayer owns a group of identical properties that have been acquired over a period of time and different costs. Then you just need to determine the cost by using the weighted average method. Let's see, if you purchase the shares a number of years of various price, if some of the shares is disposed of, so the ITA 47 requires that the just cost base for the assets being disposed of be based on the average cost of the entire group. So we could look at the examples. Example, purchased 100 shares on January 15th for $15 per share. And another 20 shares on March 12th for $20 per share. What is the cost per share when she sells 50 of her shares on December 20? So you need to calculate the cost by using weighted average method. Now we can go to the solution. We take a look at a solution. The adjusted cost base per share on December the 20th, we use 100 times $15. At the very beginning, she purchased 100 shares. And then you plus 200 times 20. So that is the $20. She purchased the next 200 shares and divided by $300 shares in total. So the average cost per share will be $18.33. So use if by any chance after December 20th, she started to sell the shares, like 50 shares. So you have to use the 50 times $18.33. So that's the new cost. Okay, so that is the weighted average method. Now, the next topic, we talk about a capital gains reserve. Okay. When the capital gain reserve, when proceeds are not immediately payable. So saying that there's installment payments happened, right? And reserve available to reduce amount of capital gain recognized each year. So this rules allows a taxpayer to deduct a reserve from the total capital gain when not all of the proceeds are received in the year of the sale. Remember the rule of the reserve from the last chapter? The taxpayer must add the reserve back in the following year's income. Then they can calculate a new reserve in the new year when it's eligible. The ITA is limit the reserve to the last of two amounts. So the formula will show as the first formula, proceeds payable after year end divided by total proceeds times capital gain, or 20% of the gain times 4 deduct number of years ending after year of disposition. So the second formula indicates that minimum of 20% of the gain must be recognized in the year of the sale in each of the following 4 years as well. However, when we take a look at the first formula, it states if the proceeds collected faster than 20% per year, the reserve will be based on the actual uncollected amount remaining. So this is the two formulas we've been learning to calculate the capital gain reserve. We could see examples together. So let's take a look at the example. We read through the question and calculate for each of the 4 years of the amount reserve allowed, if there's any, and also the amount need to be included in taxable income. So you sell a piece of property for $500,000 and collect $100,000 in the year of sale. And then the second year is 0. You didn't collect anything. And in year 3 and year 4, you collect $200,000 for each year. So the total capital gain on sales was $50,000. Now we need to do the calculation for the allowable capital gains reserve for each year. We can see that a year by year. So the first year 1, the total capital gain was given to you, $50,000. Then we have to use the formula to calculate the lesser of. The first one is proceeds payable after year end. That will be $100,000 has been paid for the year 1, right? So we use the unconnectable amount is $400,000 divided by the total proceeds, which is $500,000 times $50,000, which is total capital gain. So equals $40,000. Or the next formula, we use 20%, 1/5 times $50,000 as the total gain, and then times 4 minus number of years ending. So it's 0. 4 minus 0 equals to $40,000. So the last reserve will be the same, right? It's $40,000. So we use our total capital gain, $50,000, deduct $40,000. It comes out with $10,000. This is the $10,000 is the capital gain, and half of it will be taxable. So times 50% is $5,000 for year 1 as taxable capital gain. The first calculation, the second calculation are the same as $40,000. Therefore, 80% of capital gain is forwarding to year 1. Only $10,000 capital gain is recognized in the year 1. Half of it, $5,000 is taxable capital gain. So that's for year 1. Now we calculate year 2. We haven't received any payment. So there's nothing changed for the uncollected proceed. That is $4,000 still. But pay attention to the very beginning. The previous year's reserve included in the income. So the last year 1's reserve, that is $40,000 we put into year 2 as income, into the income. So it's $40,000 at the very beginning. And then we calculate a lesser of $400,000 divided by $500,000 times $50,000 is total gain equals to $40,000. Or we'll use 20% times the total gain, $50,000, and use the 4 deduct by number of years ending. So that's 1 year, right? Then we came out with $30,000. The lesser reserve will be $30,000. We'll use 40 deduct 30. We come out with $10,000, and then half of it will be taxable. So the taxable capital gain was $5,000 for year 2. So the new reserve in year 2 is $30,000. And then for year 3, we need to add back the prior reserve into the income, $30,000 from year 2. Then if we just compete the calculation for the two formula, the first is the uncollectible amount, right? Or year 1 we have $100,000. So we have $400,000 left. And then year 3, we have another $200,000 has been received. So this $200,000 is the uncollectible amount, okay? So it's not the $200,000 you received for year 3. That is to deduct the year 3's receivable already. So this is the left amount. It's $200,000 divided by $500,000 times the 50, the total gain equals $20,000. Or the second formula, we use 20% times 50%, $50,000 total gain times 4, deduct 2 years, you get $20,000. So the last reserve will be $20,000, and the total reserve for year 3 will be $10,000, and half of it will be taxable, so it's $5,000. The way I just want to emphasize that the way the lesser of formula work is the minimum of 20% of the gain must be recognized in the year of sale and in each of the following 4 years. This is what we have seen for year 1, 2, 3. So keep in mind, if the proceeds are collected faster than 20% per year, then the capital gain recognition is more than 20% per year. It is also mean that no reserve will be available after the end of the 5 years period, even if there's still uncollectible proceeds. The best examples, you will see that even though there are still uncollectible proceeds left, but because all the capital gain, the total capital gain, taxable capital gain have been all calculated from year 1 to year 4, it's just stopped. Okay, so there's no reserve available after the end of the year 5. So that's the good questions you can see from your textbook for that kind of questions. For our question in the PowerPoint, we could see year 4. Let's see year 4. Year 4, the same will repeat it. We add in the prior reserve, including the income, so $20,000, and lesser of the first formula will be 0 because there is no unconnectable proceeds left, right? All $500,000 has been connected. End of the year 4. So the first calculation is 0. Or the second formula will be 20% times $50,000 times 4 minus 3 years. So it's $10,000. The last reserve will be 0. So the total will be $20,000 and taxable amount will be $10,000. So that is for our quick example, very straightforward. You can do the calculation from year 1 to year 4, and you will see that how much to reserve for each year. And then you can calculate taxable capital gain. So that is for the reserve. Now, let's see next slide. We will see the topic of sale of real property. The special rules in sale of real property. The real property we defined as land and building on top of the land. So usually sale of land or building are made of one piece of price. Right? Some estimation are required to what the total amount of the price allocated to the land, what the total amount will be allocated to the building. Without a special rule for the sale of the real property, there could be a scenarios that a larger amount allocated to the land and will increase the capital gain, which only 1/2 of taxable. And then it results in a smaller amount being allocated to the building, which will result in a fully deductible terminal loss. So when you take a look at the slides, they only applied if there would otherwise be a terminal loss on the building. Usually the situation involves a capital gain on land and terminal loss on building. Relocate proceeds from land to building to eliminate it or reduce terminal loss, reduce amount of capital gain. So that's this special rule will work. It only applied if there is a terminal loss on the building. And then you have to estimate it, see how much money will allocate it to building and how much money you will allocate it to the land. We will see a quickly examples on that. So examples, building and land. The proceeds of disposition is $50,000 for building, $75,000 for land. The cost amount will be $60,000 and land is $40,000. So we'll have capital cost $71,000. If we do the calculation to calculate the capital gain or capital loss by without the special rule. So we have our proceeds $50,000 and $75 for land. We have our cost amount will be 60,000 and 40,000. So we have our top terminal loss on building is $10,000, and our land will have $35,000 capital gain. Now, we apply the special rule. We have to estimate it, how much you're gonna put into building and how much you're gonna put into land. We reallocate the $10,000 proceeds of disposition amount from land to building, which result there's no terminal loss, but only $25,000 capital gain in land. There, so you can see that our building will be $60,000. Our land will be $65,000. When you do the following calculation, there's no terminal loss left, and the only capital gain will be under land. So we have also a very good examples along with the solution in our textbook. You can just definitely refer to this topic if you have any concern. Now, next one, we're talking about principal residence. Principal residence, exemption for capital gain on principal residence. Tax rules allows for reduction of any capital gain was realized of sale of one's principal residence. So there's non-taxable. For most taxpayers, any capital gain realized on disposition of principal residence is free of tax. We should point out that in any particular year, only one taxpayer in the family unit is allowed to designate a property as principal residence. A family unit is considered as a taxpayer, the taxpayer's spouse or common law partner, or any children, unless they're married or in a common law partnership or over 18 years during the year. Technically speaking, a capital gain on the principal residence are taxable. However, the ITA for 02B provides a formula for reduction such gains. In this formula, taxpayers must designate the number of years that this property is deemed to be the taxpayer's principal residence. This is only relevant when the taxpayer owes more than one property in any particular year that could qualify as principal residence. In such situation, the taxpayer must decide for each year which property is designated as principal residence. So we can see that from the formula, the capital gain is calculated as the gain minus gain times 1 plus number of years at principal residence and deduct by number of years property owned. We will see examples later. For example, a person A owns a condo in a city and a cottage in the countryside. Both are qualified as principal residence in this example. However, A is only allowed to designate only one property per year as principal residence. A decides to sell the property. If there is a capital gain in both property, A will need to calculate the average cost gain per year on each property, and then the larger capital gain per year should be designated as principal residence, as that will shelter the larger capital gain to free of tax. The lower capital gain property per year will be subject to tax. So that is how the principal residence works. You can refer to the exercise A-9 for the exercise. We also have good examples along with the solutions in our textbooks as well under this topic. It says that assume a property was purchased and was sold for 2020 and purchased 2012. So there's 9 years the property owns, and the capital gain is $100,000. So if it's designated principal residence for 6 of the 9 years of ownership, so when you use 6 plus 1, when you see the formula, right? 1 plus number of years as principal residence. So 1 plus 6, divide by 9 years property owned, and then times $100,000 as capital gain, and use the $100,000 capital gain, deduct this total amount, and then times 50% is taxable capital gain. So if a taxpayer has only one single property that could qualify as a principal residence, that property can be designated as a principal residence for all year owned. In such situation, the use of this formula will then completely deduct any capital gain on the disposition of that property. Because when you take a look at the year, 1 plus number of year as principal residence. So if the two numbers, the 2 years, whoever owns the property and then owns the property as the principal residence the same, then this calculation will equals to nil, right? 0. So you can refer to the question on 8 to 9, and then you can do the exercises. Now, the next topic, we talk about types of capital property. The types of personal capital property has divided by 2 different types. The first is the PUP, personal use property. It's basically is the enjoyment of taxpayers, mobile, anything else with personal owns. And then the next category will be a LPP, is a listed personal property. The LPP is consists of a certain specified items or a personal use property, basically including art, jewelry, real folio, stamp, coins, rare books. So in general, the listed personal property is just subject to the same capital gain rule as would apply to another personal use property. Is only differences we'll talk about in the next slide. The PUP, the personal use property, the losses are deemed to be nil. It's never deductible. And the proceeds of disposition and the just cost base are at least $1,000. Under the list personal property, the losses can be realized, but only apply against the LPP gains. And these gains can be carried back 3 years and forward 7 years. So in using the rule to calculate capital gain on personal use property, the proceeds are deemed to be greater of $1,000 and the actual proceeds. In a very similar fashion, the adjusted cost base is deemed to be the greater of $1,000 and the actual adjusted cost base. So that is for the only differences between those 2 types of capital property. Now, the next topic, we'll talk about change in use rule. Change in use rules, deemed disposition. When a property is used to produce income and is converted to some other use, we see business from business to personal or personal to business, there's a deemed disposition for tax purpose. And the deemed disposition is set at fair market value. So when you take a look at the first one from the slides, deemed disposition of property at fair market value. And then it may result in recapture or capital gain and taxation of these forms of income, or result in revised cost for any resulting income calculation. Then there are 2 scenarios. First is the business to personal. Deemed disposition at very straightforward for this one. And as an income producing assets is converted to personal use, the fair market value is deemed to be the proceeds of disposition in business perspective. Also, the capital cost of acquiring the assets for personal use. So deemed disposition will use the fair market value, and deemed acquisition we use the fair market value. Very straightforward from business to personal convert. Now, the next scenario we'll see is personal to income producing, so personal to business. These rules vary depending on the relationship between the fair market value of the assets and its costs. So when you see the fair market value less than the costs, the fair market value used for the POD and capital cost to business perspective. If the fair market value higher than the costs, the capital costs of the reacquired costs for CCA purpose will be equal to its cost plus 1/2 of the difference between its cost and its fair market value. For purpose of determining the capital gain on the deemed disposition, the capital cost will be deemed to be the full fair market value of the assets. So that's the only differences between the fair market value higher than the cost or fair market value lower than the costs. So if it's higher than the costs, you need to consider a little bit more for CCA purpose or for capital gain purpose. Let's see an example. TP converts boats from personal use to business use. The original cost of the boat is $200,000. The fair market value at conversion is $300,000. So the fair market value is higher than the cost, right? So TP has taxable capital gain. We use 50% times the $300,000, deduct $200,000, which is $50,000. That is the taxable capital gain. Now, we need to consider the CCA. For CCA purpose, we need to use the original cost plus the $50,000 as $250,000 as our capital costs. Capital cost for capital gain purpose will be $300,000. That's equals to the fair market value. When you take a look at the top of this formula, you will see, right? Because fair market value higher than the cost. So the capital cost for capital gain purpose will be equals to the fair market value. This value will be used in the determination of any capital gain that might arise on the future disposition of the boat, as it is a depreciation asset, there could be no capital loss. So that's why we use the fair market value. Now, the next topic, we change in use principal residence. So principal residence to rental property. It's often considered when the taxpayer change from a principal residence to rental property. This election would allow the taxpayer to continue to designate this property as principal residence for up to 4 years. Even though it's used for rental property, it is important to a taxpayer that rather than buying a new home after they move out of their original home, but they could rent a place. If the taxpayer decides to rent a home after they move out, then they do not have another property to designate as a principal residence. Then this election is important because they could designate the rental property as their principal residence for 4 years. This can help them to reduce their capital gain in the 4 years, if there are any capital gain in this 4 years, right? So the inaction under ITA 48.2 may elect to have no change in use on personal to business, remains principal residence for 4 years, even though it used for rental property. Defer taxes until time of sale. Now, the next scenario will be the rental property to principal residence. There is an inaction under ITA 45.3. You buy the property and then rent it out. The late becomes principal residence. You can treat as a principal residence for up to 4 years prior to moving in. Very similar. And the next 3 slides is covering the topic of the small business investment. We do not request all the students to fully understand those because we focus on the personal income taxes in this course. So I just quickly talk about it so you can, you have a sense that what it's about, right? So the first deferred provision on small business investment. Eligible small business corporation. Investing must be small business corporation. Assets cannot be carrying value in excess of 50 million. The qualifying disposition. And so we have this very detailed explanation on our textbook. If you ever feel like you wanted to read more, it's on page 370. So we have qualifying disposition. To qualify for deferral, the gain must result from the sale of common shares in an eligible small business corporation that was owned by the investor throughout 185 days that precedes disposition. Okay. And then we have replacement shares. There are common shares of a eligible small business corporation that acquire within 120 days of the year, and that in which the qualifying disposition took place. They must be designated as a replacement share in the individual's tax return. And then for permitted deferral. Permitted deferral is limited to a fraction of the capital gain resulting from the qualifying disposition. The fraction is based on a ratio of the lesser of the cost of replacement shares and proceeds of disposition. So this, please note that this fraction cannot exceed 1. So this formula, when you take a look at the slides, you can see that the gains times the lesser of adjusted cost base of the new share and the POD, the proceeds of disposition of the old share, and divide by the proceeds of disposition of the old share. So this fraction cannot exceed 1. The formula means as long as the ACB of the new replacement shares are equal to or greater than the proceeds of disposition of the old share, then the entire gain will be deferral. Okay. As long as the ACB of the new replacement shares equal or higher than the POD of the old share, the entire gain will be deferral. So for ACB reduction, permit deferral is subtracted from the cost of replacement share. And the last slide, just want to show a quickly summary for the replacement property rule. Again, we do not ask you to remember everything, but just to know it, right? So the type of disposal, we have volunteer or involunteer. The eligible assets, you can under volunteer is formal business property, and time to replace is 1 year, 12 months from end of the year of disposal. If it's involuntary like damage or theft or steal, destruction, involuntary is under eligible assets will be any capital property. There are 24 months from end of the year of disposal. So capital gain is deferred to the extent that full process are reinvested in the new property. Recapture is deferred to the extent that amount equal to the recapture, otherwise calculated invest in the new property. Deferred capital gain and recapture are built into the tax basis of the new assets by reducing the ACB of the new assets accordingly. So that's a basically summary for the replacement property rules. And that's basically everything for chapter 8. It's a little bit more, quite a few information in this chapter, but pay attention to the first a few chapters for the capital gain, capital losses calculation, and then their principal residence and special assets disposition. So make sure that you understand all those topics. Okay, thanks.